Hello and welcome back to goldstocktrades.com. Today we have back here with us today Jos Desmet. Jos is CEO of CanAm Coal. CanAm Coal can be traded as COE on the venture, and it also can be traded as COECF on the OTC. Thanks, Jos, for being back here with us today.
Thanks for having me, Jeb.
Jos, tell us, you've had experienced some significant growth in producing coal this past year. What got your group interested in coal?
The origins of our company have always been in the coal industry. Our expertise, that's where our expertise lies. And originally, when this company started, we signed up about a 300 million ton of lignite coal resource in Colorado. And so we're coal guys, and when the markets, the financial markets downturn hit in 2008, we basically decided we wanted to get into the coal producing story, and we continue to be long-term believers in the coal story. Coal is not dead. Coal is a major fuel source today and going forward. And if you look at the Asian story, I think the International Energy Agency group predicts that coal demand is going to grow by about 20% between now and 2016. So from that perspective, we continue to be strong believers. And although renewable energy will play a more important role, we still believe that there's a place for coal, and coal will do well going forward, and that's why we continue to believe in our story, and we'll continue to grow our company.
Just, you recently announced on April 26, 2013, the fourth quarter and full 2012 results that delivered $3.2 million of EBITDA in quarter four. Can you highlight some of the significant news from that development?
Sure. Our 2012, Jeb, was another record year, so to speak. We had production of about 455,000 tons, revenue about $45,000 million, and EBITDA of about $8.5 million. That EBITDA was up from about $4.5 million in 2011. So, significant growth at all levels. And one of the ways we've been able to achieve that is obviously we've acquired another 30% of Birmingham Coal and Coal on July 1st, 2012, which gave us obviously additional production revenue and EBITDA, but also at the same time when we did that acquisition, we actually decided to centralize, integrate our operations across all of our mines, and as such we've been able to generate some significant mine and operating improvements, which resulted in these great results for 2012. That having said, it was a great year, 2012, but also we had some challenges. As you will remember from our previous discussions, we had been waiting for 3 new permits, and we were basically 6 months behind on each of those permits, which has given us some operating challenges in 2012. As you run out of mine, the mining conditions become much more challenging, and therefore, being able to produce and generate some good results was a little bit more challenging in 2012. But obviously, we are behind that now. And we've started at developing our 3 new mines at the end of 2012 and into 2013. And actually, the mine permitting delays also resulted in us having to build mine infrastructure during the worst period of the year, which is mainly December through March, when it's extremely wet down in Alabama. With respect to CapEx, Jeb, 2012 was another significant year. We expended about $14 million in new and refurbished equipment, and also we spent about $3.5 million on permitting and mine development. By basically doing that in 2012, we have really positioned ourselves for 2013, where our CapEx will be significantly lower going forward. And then the last major achievement that we believe we attained in 2012 was our ability to attract a significant financial institution in the U.S. that refinanced all of our equipment debt, about $16 million of equipment debt at a rate of about 3.25%. And also they were willing to give us an operating facility, $3 million operating facility. Again, we believe that attracting this type of a financial institution is a testament to the sustainability and the profitability of our business model going forward. So from that perspective, 2012 was extremely good year and has positioned us well going forward, Jeb.
Talk a little bit about going forward, some of your outlook in 2013 and especially Q1.
Yes, we continue to believe in our story and see significant growth in 2013. If you look at also our Q4, we turned the corner from a free cash flow perspective. As I pointed out, we did major investment in 2012, and obviously that basically resulted in us taking our operating cash flow and reinvesting in the business. As we come into 2013, and with our significant growth going forward, we believe we will be generating some significant free cash flow going forward. Our sales guidance that we've issued previously still stands. We believe we'll be generating between 700,000 to 900,000 tons of sales in 2013. We will achieve this, through a number of mechanisms. First of all, obviously we will have a full year impact of the BCC acquisition in 2013, but also obviously we are opening up 3 new mines. Our old Union 2 mine, our ninth mine, and our Poser 2 mill will going full steam ahead starting the second quarter of 2013, and we'll be in full production at that stage, and we will continue to produce from our Powhatan mine. From a sales perspective, we're in a very fortunate position. As I pointed out before, we are basically at the lower end of our guidance. We're sold out. We have contracts in place for 700 to 750,000 tons. So at the lower end of our guidance, we're basically sold out. We're also substantially sold out for 2014. We're probably up to 70% sold for 2014, and we're currently talking to a number of our customers about extending their contracts into 2014. From a risk perspective, we've taken off the permitting risk with 3 new permits. We've done CapEx. It's really now, collecting the fruits of our labor, so to speak, in 2013. Once we've got these mines up and full production, and we believe that 2013 will be significant. As to our Q1, it's been challenging Q1, and the main reason why it's been challenging, we obviously had to maintain our production, and our production sales came in at about 150,000 tons, which is a little bit lower than our Q3 and our Q4. But at the same time, we had to develop 3 new mines. The major work at our old Union 2, Knight, and Poser Mill mine, was done in the Q1 of this year, and in very difficult circumstances because it was really rainy and wet down in Alabama. And then, as you develop the mines, obviously the mining conditions are still a little bit tricky, so to speak, and less efficient than you would expect them if you run the mines and in a full production mode. At the same time, when we were doing our production or developing our production, developing our mines, we also had to do a number of reclamation activities. As you wind down a mine, so we shut down our Bear Creek mine, we shut down our old Union 1 mine. At the same time, you need to start doing reclamation because you have about 6 months period of time when you have to complete reclamation once you're done with the mine. So Q1 was challenging from that perspective, that we had to maintain production, develop our mines, and do all the reclamation of our old mines. So it was certainly challenging, but I think we're past that Q1 now, and Q2 we will be in full production mode, and it'll be a great Q2 and Q3 and Q4 going forward.
Just as we conclude, let's talk a little bit about CanAm Coal and how it's compared to some of its peers in the coal sector. You've been having strong production growth, significant EBITDA growth compared to some of your peers.
Mm-hmm. I think the way we we differentiate ourselves. A lot of the producers have been shrinking. As you pointed out, we keep on growing. And we see our sales growing from 450,000 tons to at least 700,000 tons this year. So that is also significant growth compared to anybody else who's probably shrinking out there. From a sales perspective, a lot of the producers are struggling. Contracts are being canceled. The markets are difficult, but we are substantially sold out, which is it's extremely positive position for us to be in. From a quality of coal perspective, I believe I've told you before, a quality product sells in a good and a bad market. The fact that we're sold out pretty much tells you that we've got a quality product. Our coals are meeting, the current and the new EPA requirements going forward. So I believe that's a significant differentiating factor going forward. From a location perspective, we are very close to our markets, and also our proximity to the seaborne markets will benefit us going forward. Actually, more recently, talked a little bit about the overall markets, but we believe to a certain extent that the overall markets are picking up. We have had many requests for our thermal coal going into the seaborne markets, and more recently, actually, we started shipping some of our met coal into the seaborne markets, which we haven't seen in certainly in the last 6 to 12 months. So there's some encouraging signs out there that are happening in the market. From a valuation perspective, we are trading at a market cap of about $12 to $13 million. Compared to anybody else out there, that's less than 1 times EBITDA for 2013. So typically companies trade about 4 to 5 times EBITDA. So we certainly believe that we're significantly undervalued at this stage of the game.
Well, Just, thanks for being back here with us today and for giving us an update on CanAm Coal.
Okay, thanks very much, Jeb. Good talking to you.